uh, formal revocable trusts, sometimes known as living or family trusts. Again, these are usually drawn up when you have estate planning purposes. The owner controls the funds and other assets in the trust during his or her lifetime. The agreement establishes that the funds are to be paid to one or more identified beneficiaries upon the owner's death. The trust generally, now let me say this again, the trust generally becomes irrevocable or partially irrevocable upon the owner's death. Next slide, please. We get a lot of questions about beneficiaries. Who can be a beneficiary? So here it is in a nutshell. All living persons, all natural living persons can be a beneficiary. Charities can be a beneficiary, and nonprofit organizations recognized by the IRS. If you want to know which charities or organizations are recognized by the IRS, you can go on to irs.gov, and they have a list of charities that they recognize, and then those would be considered qualifying beneficiaries for share insurance purposes.
So my dog Leo, could he be a beneficiary of my trust?
Unless the IRS recognizes him as a nonprofit, I don't think so.
Okay.
So Sheila's going to, in the next couple of slides, actually show you how you calculate the share insurance using beneficiaries.
Next slide, please. So most often for revocable trusts, and this is generally speaking for those trusts that have 5 or fewer beneficiaries, the share insurance coverage can be calculated as follows. We take the number of owners on the account, we multiply that by the number of beneficiaries that are named, and we multiply that by the $250,000, and that equals the share insurance coverage. Special rules do apply when there's 6 or more beneficiaries, but generally speaking, for a majority of the revocable trusts, they have 5 beneficiaries or less, and the calculation is pretty simplistic. So next slide, please. So an example, pretty simple math. First example, 2 owners and 3 beneficiaries. 2 times 3 is 6. Times $250,000 will give you $1.5 million in share insurance coverage. If you have an account that has 1 owner and 5 beneficiaries, 1 times 5 is 5, times $250,000 will give you $1.25 million in coverage. So an important thing to note is a lot of people do mistake this, is the revocable trust itself does not get an additional $250,000 in coverage. So that's important because some people do make that common mistake. Next slide, please. Discussing again a revocable trust with 5 or fewer beneficiaries. The coverage is $250,000 per beneficiary for each owner/member. And what's kind of unique about the revocable trust coverage is you can have an unequal distribution of funds, meaning if you have 4 beneficiaries, you don't have to leave the same amount of money to all those individuals. And I think Leilani is going to go over an example that we have that on the next slide.
Next slide, please. So here's our example based on the last slide that Sheila just used as a calculation. So we have a revocable trust, and it's going to be less than 5 beneficiaries. So Rob has a revocable trust with $800,000 in it. He wants to provide for his 2 daughters, Leilani and Sheila, by naming them as beneficiaries. So based on his current balance of $800,000, we've calculated that $300,000 is uninsured. So again, based on what Sheila said, that it's based on the beneficiaries, 250 times 2 beneficiaries, that's $500,000.
So the calculation is Rob is 1 owner.
Rob is 1 owner, 2 beneficiaries.
Okay.
So that would be 2 times 250. So that's where we get the uninsured balance of $300,000. If Rob were to add 2 additional beneficiaries, Rick and Annette, the insurance coverage on the account would be $1 million. Again, this is 4 times 250, not the owner, but the beneficiaries, and that gives you $1 million. Even though he's only going to leave Rick and Annette $5. So Leilani and Sheila get $399,995
Woohoo.
each, and Rick and Annette get $5. So at this point, since he did add Annette and Rick to get the additional coverage of $1 million, his account is fully insured. Sheila's going to go on to revocable trust for 6 or greater beneficiaries.
Next slide, please. Okay, here the rule gets a little tricky. If there are 6 or more beneficiaries, your share insurance coverage, your account is insured for the greater of either the sum of each beneficiary's actual interest up to $250,000 each, or $1.25 million. Again, the greater of either the sum of each beneficiary's actual interest in the account up to $250,000, meaning if you want to give a beneficiary $300,000, they're only going to be insured up to $250,000.
That's right.
Or a total of $1.25 million, whichever is greater. So, and if you have any questions on revocable trusts, you can certainly call our number and our analysts would be happy to help you. So moving on, next slide. So a lot of times we'll get a question about a trust and the trust as the beneficiary. So you can list a formal trust as a beneficiary. So for example, you can designate on a payable on death account, which is an informal trust, that the beneficiary of that informal trust is the Sheila Memorial Trust, which is a formal trust. So the insurance coverage is calculating using the beneficiaries that are named in the Sheila Memorial Trust, as if the account has been titled in the name of the Sheila Memorial Trust. Can I have the next slide, please? So one of the caveats here is this treatment is applicable only if the owner or co-owners of the share account own 100% of the formal revocable trust named as beneficiary. In other words, the owner of the payable on death account must be the owner of the formal revocable trust. So we're going to talk a little bit about our share insurance estimator tool that's on our website when you're calculating coverage. So one thing, when you have a trust as a beneficiary, you have to list out the trust beneficiaries for the calculation to be accurate. So if you just put in the trust as the beneficiary, you're not going to get an accurate calculation. So I think I'll turn it over to Leilani.
Next slide, please. Looks like we have a poll question. So here we go. How long does share insurance coverage remain unaffected after the death of an owner? A, affected immediately. B, 6 months. C, 12 months. D, 24 months.
Do, 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 do. Is that copyrighted?
I don't know. Okay. Do we have no answer? Where is it calculating?
You can. It's not giving you the percentage, but you can see the numbers.
Okay. Should we stop it? You can stop the poll. Usually no answer.
Affected, well, no answer is the most, but then affected immediately is the contender.
Okay. Well, this is good that we are sharing good information to help you along with what happens at the death of an owner. Next slide, please. The answer is actually B, 6 months. Next slide, please. Thank you. So what happens is the death of an owner will not affect the member share account for a period of 6 months following the death of a member. What needs to happen is that the person who has the account needs to either restructure it, like if it was a joint owner, And so the other owner would need to restructure the account so that the insurance would stay in place, or what would happen is that the share insurance coverage will be provided on the actual ownership of the account. Next slide, please. Next slide, please. What I wanted to do in the next slide is show you an example of how an account would or would not be restructured, what would happen. Small hiccup.
I don't have the hiccups.
There we go. There we go. Okay, so we have a joint account, owner 1 and owner 2, and they have a balance in that account of $500,000. Again, we take an interest of 50%, and owner 1 has a balance of $250. So their insured coverage would be $250. So that portion is none is uninsured. Owner 2 again has a balance of $250. It's insured up to $250, so nothing is uninsured. Owner 2 passes away. Owner 1 does nothing. What happens is that owner 2's balance goes into owner 1 as far as the account. It becomes, instead of a joint account, it becomes a single account. So the balance for owner 1 is $500,000. His insurance coverage now is $250, and his uninsured balance is $250.
So what can they do, Leilani, in order to increase that coverage?
Owner 1 could add 2 beneficiaries, and that could get him coverage of up to $500,000.
Okay, so that's strategic restructuring.
Absolutely.
Okay, awesome. So I guess next slide. So to change topics a little bit, mergers, they happen sometimes. So if you have an account that's in a credit union that is merging, and you also have an account in the continuing credit union or the credit union that's taking over the merging credit union, you do have some insurance coverage for 6 months after the merger date. So when you have a credit union that's merging, its insured status terminates on the official date of the merger. So once that merger has been voted on and approved by the membership and all the cancellation documents are submitted and so on and so forth, we have the official date of the merger. So from that date and 6 months forward, if you have double accounts, one in the merged credit union, one in the continuing credit union, your insurance coverage continues for 6 months after the merger date. So a little bit of a nuance with share certificates. Share certificate coverage, insurance coverage extends to the earliest maturity date after the 6 months. So if you have a merger event that, if a merging credit union is insured status is the official date is July 1st. And if you have a share certificate that matures on August 31st, so you would actually have the share insurance for 8 months instead of the 6-month time frame. There are other considerations to begin if the share certificate matures within that 6-month time frame, but we're not really going to get into that. So can we have the next slide, please? So just wanted to talk a little bit about our share insurance resources that we have available on our website, which is mycreditunion.gov. Please write that down. Please look at it, mycreditunion.gov. So on our website, we have our share insurance estimator, NCUA share insurance estimator. We also have a bunch of videos, overview, review of the account ownership types, what we talked about today, instructional videos on how to use the share insurance estimator. We also have a bunch of materials in regards to your insured funds booklet, how your accounts are federally insured. It's a brochure. There's a share insurance coverage overview and information graphic. That's pretty, summarizes it in like a page or less. And these publications are also available in Spanish, so for that segment of your membership. So next slide, please. And to avoid any technical difficulties with doing a demo on the Share Insurance Estimator, we just gave you a screenshot of what it looks like. If you go to mycreditunion.gov and hit Share Insurance Estimator, that's what your first screen is going to look like. And if we can have the next slide, please. It will ask you to input the name of your credit union, and you can also research to make sure your credit union is one of us that's federally insured. And you would pick then what your account type is, be it a personal, a government, or a business account. And for this example, I just picked, let's say a personal account, and it also gives you the drop-down menu of the ownership types. So that just shows, the different types of coverages available. And one friendly reminder, if you will, is please fill in, all the boxes, all the blanks to your best ability to get the most accurate calculation. And again, if you have any issues with using the calculator, what you can do is go to the next slide, please, Chan. And feel free to contact our office with any questions or comments regarding Share Insurance. And that phone number is 1-800-755-1030, and you want to hit option 1. 1-800-755-1030, option number 1. And if you don't like to talk on the phone, which a lot of people don't for some reason, you can also email us at dcamail@ncua.gov, which is dog Charlie Apple mail @ncua.gov. So we'll be happy to respond to any of your questions. Please provide as much information you have about your question, to reduce the ambiguity and the whatnot, and we'll try to get back to you as soon as we can. So thank you very much.
Thank you so much, Sheila and Lalani. That was very helpful information that you provide. And I just want to share one other resource. I mentioned the learning management system that NCUA has that is available to credit unions. And there is a course called Understanding Share Insurance, and it covers everything that they talked about today plus some. So I encourage you to, check out that resource as well. So we do have time for a few questions. If you have a question, please use the Ask a Question feature. If we don't get to your question today, don't worry. We will get an answer for you and include all those questions with their answers with the webinar recording when it is loaded to NCUA's Learning Management System. Now I would like to welcome to our webinar Rita Woods, who is the Director of Consumer Access, who will be asking the questions of our two speakers.
Thank you, Ron. We have quite a few questions already, and so I'll get started. First question I'll give to you, Sheila.
Me?
Yes, of course.
I'm on the hot seat again?
I think so.
Okay.
So here we go.
All right.
If a member has an individual account as well as a single member LLC account using the same Social Security number and tax ID number, is that LLC insured separately from the individual account, or are they aggregated together?
Because I guess the key there is it an independent activity? I would say you would aggregate those accounts together?
In general.
Generally speaking.
Generally
Because
speaking,
we're
yes.
using the same TIN number, we're using, which is the tax ID number. And yes, you would aggregate those.
Okay. Thank you very much.
Thank you.
Next question, which I think, Leilani, you covered this in your, as part of, the presentation. Do beneficiaries affect coverage for individual and joint accounts?
Can you say that one more time?
Do beneficiaries affect coverage for individual and joint accounts? So, is having a beneficiary on an individual and a joint account, does that change the coverage just because they have a beneficiary?
Yes, it does. So when you add a beneficiary to a single or joint account, it becomes an informal trust, and then we calculate the insurance based on how many beneficiaries you have on those accounts.
Okay, thank you. We'll move on to the next set of questions here. So, Sheila,
No, you're good. Yes.
do my beneficiaries need to be blood related to the owner of the share account?
So the question is do the beneficiaries need to be blood relations of the owners? And no, they do not. A beneficiary, qualified beneficiary, is a natural living person, a charity, or a nonprofit recognized by the IRS. They don't have to be related by blood.
Okay, thank you. Leilani, we'll go to the next one for you. Are all state chartered credit unions insured by NCUA?
Are all state chartered credit unions insured by NCUA? No. Some state chartered credit unions are privately insured. So if you wanted to check to see if your credit union was insured, you'd go to research a credit union on ncua.gov. Only federally insured credit unions are listed there.
All right, thank you. Next question, Sheila, this is for you.
Okay.
So, is a co-owner on a revocable trust account insured if they are not a member in their own right?
So you want to know if a co-owner on a revocable trust is insured, their interests are insured if they're not a member.
Correct.
Well, if we go back to that membership slide, not that I'm having you go back to it, but no, a revocable trust co-owner needs to be a member in order for their interest to be insured, their respective trust interest to be insured. So as such, any co-owner that is not a member of the credit union is not insured.
All right, okay, thank you. Next question, Leilani, this is one for you. Is the interest in an employee benefit account insured any differently than a member's individual account?
So the question is a employee benefit account insured differently? So if an individual has a single account and then they also have an interest in employee benefit account, that account would be insured separately. And the individual's portion in the employee benefit account would be insured up to, their portion would be insured up to $250,000.
All right, thank you. Questions still coming in, Sheila. This one is for you.
Okay?
All right, in the event that the federal insured credit union fails,
Mhm.
are the insured funds paid to the owner of a revocable trust or the beneficiary?
Okay, well, hopefully we don't get too many failures, but it has happened. And because the owner of the account actually owns the funds of the account, if that credit union were to fail, the funds would be issued to the owner of the account, not the beneficiaries. The beneficiaries come into play when the owner passes away, and then the beneficiary gets the funds.
Okay, thank you. All right, next question. Leilani, this one is for you. If I have a traditional IRA and a Roth IRA, are those insured separately?
If you have a traditional IRA or a Roth IRA, NCUA would add those together, aggregate them together, and those accounts would be insured up to $250,000.
Okay.
What happens if I had beneficiaries on those?
You can have beneficiaries on there, but they don't add additional coverage for you.
Oh, thank you.
All right, okay, Sheila, next question for you, we'll take it from here. If a POD, payable on death, as you indicated before, is listed on the account and the beneficiary is not a member, would they still have coverage of $250,000 for the individual, or would the coverage be zero?
So if you have, the beneficiary is not a member of the credit union,
Mhm.
but you have a payable on death and you name that that person as a beneficiary, yes, there would be coverage up to $250,000 because a beneficiary does not need to be a member of the credit union.
Absolutely, great, thank you.
Mhm.
All right, Leilani,
Mm.
next question for
Okay.
you. How long does it take to get my money back if my credit union fails?
My money.
So in general speaking, because there's always exceptions to that rule, but in general, we would like to cut the check within 3 days of the credit union being liquidated. So again, in general, 3 days.
All right, perfect, thank you. Sheila, I think we have time for a couple more here.
Okay.
Can owners make themselves beneficiaries?
So the owners want to make themselves beneficiaries of the account.
Yes.
Okay, well, I mean, they could do that, but they're not going to get any additional coverage for that because you can't double count yourself. You can't be an owner and a beneficiary at that point.
Oh,
So,
okay.
yeah. So
All right.
you could, but it doesn't really get you anything.
Okay, great. All right, thank you. Next question, Leilani, this one is for you. Um, If the crediting system shows member number 1 as a primary member and member number 2 as a sub-member on a joint account, does the sub-member have to have their own member number in order for the account to be considered a joint account?
Okay. So what we have here is a credit unions using different scenarios. It doesn't matter if you have a primary member or a sub-member. A co-owner is a co-owner. So if the owners have signed a signature card or some type of evidence such as that, or also has a right of withdrawal, both owners can withdraw the money at any time, then they are considered owners of that particular account, and they would be insured as such as joint owners and would be insured for $500,000.
Okay, great, thank you. All right, I think we're getting close to the time, so Sheila, let me just go to you for just couple more questions here.
Okay.
So for a revocable trust, is a beneficiary considered an owner for insurance purposes?
No, no.
Hmm.
Sorry, that was pretty blunt, but no.
Okay.
Because as we discussed, we're concerned as far as share insurance coverage, who are the owners and who are the beneficiaries? Well, you're one or you're the other. So, yeah, no, a beneficiary is not really an owner of an account, of a revocable trust account.
All right, so just one last question. Just want to get the last one in here, and because I think this was an important one. Sheila, we'll stick with you here. Why would a credit union not be allowed to treat all beneficiaries equally?
Why would a credit union not
Why
be
would a
allowed?
credit union not be allowed to treat all beneficiaries
Well,
equally?
Okay, so the credit union does not own the funds. Okay, it's the owner who owns the funds, and it's the owner who could decide whether Leilani gets a 250,000 and Frank only gets $5. That's up to the owner. So of the trust, I'm not sure. The question is a little weird, but but for insurance calculation purposes, I mean, if we have 5 or fewer beneficiaries, we do allow up to $250,000 for each of those beneficiaries, regardless of the unequal interests.
Okay, very good. Thank you. I think that concludes our Q&A. And Ron, back to you.
Great. Thank you so very much, Leilani and Sheila, for answering those questions. If we could go to the next slide, please. And also thank you, Rita, for asking the questions. That's all the time we have for the Q&A part of this webinar. This is how you can contact CURE. So, please take note of this. Also, I want to thank our amazing webinar support team, Chan, Lauren, and Gerardo. And again, in a few weeks, we're going to post this entire webinar along with our Q&A on NCUA's learning management system. If you asked a question today and it didn't get answered, please don't worry. We will get an answer for you and post it to the LMS as I mentioned earlier. So that concludes our webinar for today. Thank you so much for joining us. Please enjoy the rest of your day.